All right, today we're tackling a question that on the surface seems to make absolutely no sense. It's a real puzzle that has a lot of very smart investors just scratching their heads. So let's dive right in.
Think about it. When a war breaks out, the first thing markets do is panic. It's a classic fear response. We see this massive flight to safety, a huge sell-off of anything considered risky. And yet, time and time again, after that initial shockwave hits, Bitcoin seems to not only recover, but actually rally. And this just creates so much confusion. I mean, how can an asset famous for being volatile actually seem to thrive in the middle of all this global chaos? Well, that's exactly what we're going to break down in this explainer.
So let's start by unpacking what I like to call the wartime paradox. We're going to put the popular myths side by side with the actual market mechanism that's really at play here.
You've probably heard this one before, right? The myth that war is good for Bitcoin. The idea that it's this digital safe haven, like a new kind of gold. But the reality, especially in those first few critical hours and days, is the complete opposite. What we actually see is an immediate, aggressive, risk-off shock. It's a classic case of sell first, ask questions later.
And just look at the scale of that shock. During one recent crisis, the entire crypto market cap lost $128 billion. And get this, that was in just 1 hour. That is not a safe haven talking. That's a market in a full-blown panic, treating Bitcoin just like any other volatile tech stock.
And that's really the crucial point here. Bitcoin is what traders call a high beta asset. Now, in simple terms, all that means is it tends to amplify what the rest of the market is doing. So when the market's feeling good and going up, Bitcoin can absolutely soar. But when the market panics and sells off, Bitcoin often falls way harder and way faster than almost anything else.
Okay, so to really get why it rebounds, we first have to dissect that initial crash. Let's take a look at the anatomy of that shock, focusing on those first critical 72 hours.
The market's reaction pretty much unfolds in these predictable phases. In those first 24 hours, boom, you get the flash crash. That is pure capital flight. Then, the next day or two, that's what we call peak uncertainty. Everybody's just trying to figure out what in the world happens next. It's only after about 3 to 10 days that we start to see some kind of stabilization response begin to take hold.
But what's really driving this initial crash isn't just fear. It's something a little more mechanical. We're talking about margin calls. See, traders who have borrowed money to make big bets are suddenly forced to sell their most liquid assets, and often that's Bitcoin, just to get cash fast. This kicks off a domino effect, a mad dash for the US dollar that just sucks liquidity out of the entire system.
Now, the very first real-world economic impact we can see is in energy. Conflict in a place like the Middle East immediately makes everyone nervous about supply disruptions. And we saw this play out in the June 2025 conflict. The price of oil jumped from $67 to $76 a barrel in just a few weeks. This right here is the first domino in a much, much bigger chain reaction.
And that spike in oil prices, it leads us directly to the front door of the world's central banks, especially the US Federal Reserve. And suddenly, they're facing this massive dilemma, this battle between their two main jobs, fighting inflation and preventing the whole financial system from collapsing.
So why is this so tricky for them? Well, because a spike in oil is inflationary, plain and simple. Research shows that a sustained 10% jump in oil prices can push headline inflation up by about 0.4 percentage points. This puts policymakers in a terrible spot. On one hand, the market shock is screaming recession warnings. On the other hand, inflation is starting to heat up. What do you do?
Faced with this impossible choice, what do? They can't just cut interest rates, because that would make inflation worse. But they also can't just let the financial system freeze up. So they reach for a different tool, something called stealth easing. And this is absolutely crucial to understand. These are actions specifically designed to pump cash, liquidity, into the banking system just to keep the lights on. They're framed as these boring technical adjustments to fix the financial plumbing, not as some big economic stimulus plan.
And we are not talking about small adjustments here. In one recent 5-day stretch, the Fed quietly injected $125 billion into the banking system. The goal wasn't to make everybody rich. It was to make sure banks had enough cash to operate smoothly and prevent the kind of systemic meltdown that can happen after a major shock.
So you have this massive injection of cash. It has to go somewhere, right? This creates what you can think of as a global liquidity wave. So let's follow the money and trace where it actually flows.
The legendary investor Stanley Druckenmiller said it best. Earnings don't move the overall market. It's liquidity that moves markets.
This is really the core insight. Forget everything else for a second. The single most important driver of asset prices is just the amount of money flowing through the system, period.
Analysts have a way of tracking this. They use a metric called global M2. Now, you can just think of it as a rough measure of the total amount of money sloshing around the entire global financial system. When central banks hit the print button, even quietly, this number goes up.
And this brings us right to the final piece of the puzzle. We've had the shock, we've had the central bank response, and we've got this new wave of money. Now let's see why Bitcoin acts like the perfect sponge for all that new liquidity.
So why Bitcoin? Well, think about it. Unlike stocks, its value isn't tied to company earnings, which are obviously at risk during a slowdown. And unlike gold, which people mostly see as a defensive move, Bitcoin still has that high beta kick. It's a speculative, digitally scarce asset that is just perfectly designed to soak up all that excess money when investors start feeling brave again. And here it is. Here's the data that just ties this whole thing together with a bow. Look at that number, 0.94. Between 2013 and 2024, the price of Bitcoin had a stunning 0.94 correlation with global liquidity. I mean, a perfect correlation is 1.0. So this is an incredibly strong relationship. It's basically proof that Bitcoin's price is just super sensitive to the amount of money in the system. And look, this isn't just a theory. We've actually seen it play out. In October 2023, after an initial dip of 4.5%, Bitcoin rebounded strongly. Even more dramatically, in June 2025, after dropping 6% at first, it then rallied an incredible 62% to a new all-time high over the next couple of months. The pattern is consistent. You get the initial shock, you get the policy response, and then you get the liquidity-driven rebound. Okay, so let's put all these pieces together. Let's walk through the entire macro reaction chain that explains this whole paradox from start to finish. It really works like this. Step 1, a geopolitical shock causes that risk-off panic. Step 2, this triggers a spike in energy prices, which fans the flames of inflation fears. Step 3, to stop a financial crisis in its tracks, the central bank injects liquidity, usually through that stealth easing. And finally, Step 4, as this high-beta, finite asset, Bitcoin, acts as like a sponge, soaking up that new liquidity and pushing its price higher.
So the most important thing to take away from all this is simple. The rebound has nothing to do with war being good for Bitcoin. It's not driven by geopolitics at all. It is the direct, almost mechanical consequence of a very predictable monetary response to any major crisis. And that leaves us with a really fascinating final question. If Bitcoin's price is this sensitive to changes in the global money supply, is it evolving into something new? Not just a currency, not just a commodity, but maybe the world's purest, most real-time barometer for global liquidity. It's definitely something to think about. Thanks for watching.